What's going on, everyone? This is David Green, your host of the BiggerPockets Real Estate Podcast and Mortgage Monday, coming with my partner and the broker in the One Brokerage, Christian Batchelder. And today we are going to be talking about loan rate updates as well as different loan options that you might not have known if you've ever been at a real estate meetup, a cocktail party, even a virtual summit, and you heard somebody say things like DSCR, second home loan, or bridge product, and you had no idea what they were saying, so you just swirled your drink and said, as if you understood. After today's show, you won't just have to say, you'll be able to say, because we're going to be getting into it, explaining what your different options are, where rates are, and which products work best for which investors in which situation. Without any further ado, let's get to it.
But before we get into that, investing in real estate is a great step towards financial freedom, but the hassle of collecting rent, managing cash, and depositing checks can feel like anything but freedom. That's why you need RentApp. With RentApp, you can enjoy secure direct deposits to your bank account using ACH bank-to-bank transfers. Tenants can schedule rent payments and build credit while you get payment notifications, secure processing, all with a free and effortless interface. Other peer-to-peer payment apps aren't designed with investors in mind. RentApp is specifically tailored to prevent scams and ensure a smooth transaction every time. Here's how it works. 1, your tenant uses the app to pay rent, connecting their bank account to schedule payments. Number 2, you'll receive a notification from RentApp asking where to deposit the funds. And that's it. Payments arrive directly to your bank account within 2 to 3 days, with instant payments coming soon. Experience the simplicity and security of RentApp today, the better way to collect rent. Go to rent.app/landlord to get started today. And now, back to Mortgage Mondays.
Christian Batchelder, welcome to Mortgage Monday.
Happy to be here. Another good Monday in the mortgage world.
Absolutely. As we are slogging our way through this very rough real estate market, rough for real estate investors, rough for homeowners, rough for those that are working in the industry, we at BiggerPockets are bringing you the information that you need to make the best choices for you and your family and building wealth through real estate. And today we're going to be talking about where rates are and where this relates to where rates have been and where they might be going. So let's jump right into this right now, Christian. We've got several different loan products that we offer at the One Brokerage. We're going to go through and give basically in general where rates are for each of these loan products. So people should learn a little bit about different loan options as well as where the rates are for each one right now. So let's start with the government loans. Talk to me about rates for FHA and VA loan products.
Absolutely, guys. These are naturally going to be the lowest loans in the industry as well as the lowest down payment. The VA loan, obviously, you got to be a veteran. So unless you've served your time in the U.S. military, appreciate the service for everybody who has. But you get benefits of the best loan product in America. 0% down, no PMI, lowest rates in the low to mid 6s right now, depending on where your credit score is. Very good loan products, always the leader, okay, in terms of affordability on the loan. So if you got your VA loan, please use it. Primary residence only loan, 1 to 4 units. It's the best loan product in America. If you're a vet and don't own a home, you got to get into a home. It's easier for you than anybody else, qualifying wise and down payment wise. For the second government loan, we have FHA loans. Those are typically slightly higher, if not right at par with the VA options. Probably around mid 6s is where we're at right now, 6.5 or so. The downside of the FHA as opposed to the VA loan is that you do pick up that mortgage insurance. We've talked about PMI a lot on previous episodes. FHA both has an upfront fee that is financing your loan as well as a monthly payment, including in your PMI. So just keep that in mind. Make sure you're adding that onto your monthly payment. But FHA, still 3.5% down. Really good loan product for people looking to get into their first home for a low out-of-pocket expense. Mid 6s for both of those right now.
Is there any reason why somebody should not use a VA loan if they're a military member and they're looking to buy a primary residence?
No. I'll just make it easy for you. Absolutely not. It's the best loan product out there. It does have to be your primary. You do have to be a veteran. Those are the only 2 downsides of it.
I've heard you say that before. Like you look at it like it's the super loan. So I just wanted to highlight that. So if you're a VA member and you don't own a home right now, that needs to change. All right. The FHA loan. Who should use this loan product and who should not use this loan product?
A lot of people just think first time home buyer, got to go FHA. Not always. A lot of times there's a better conventional option. A lot of people, incorrectly use FHA, first time home buyer in the same talks. It's not. The FHA is a great option if you have lower credit. If you're also a little bit too high on your debt to income, the FHA is a little bit more forgiving. So always talk to your loan officer, ask about both the first time home buyer conventional and FHA options, and help them help you decide which one is best for your situation.
All right, moving on to the next batch of loans, we have conventional loans. Now, this is what I would say our general audience believes loans are. So we're going to be talking about a primary residence home loan, a second home loan, and an investment property home loan. When we say conventional loans, we're talking about loans that are insured by the government. If you've ever heard people say the phrases Fannie Mae or Freddie Mac, these are two of the government-sponsored enterprises that partner with the government to make sure that once a loan is originated, it can be sold and ultimately packaged usually as a mortgage-backed security so that there's always new money flooding into these loan programs and the government can keep giving loans. These are typically, unless you're a veteran and can use a VA loan, where your best interest rates are going to be. And that's why most people hear about these loans most common. So where are rates for primary home loans right now?
Yeah, absolutely, guys. So we started with government, which is in those low to mid sixes. And granted, remember, this is being recorded in May of 2024. So obviously rates are time specific, but these are going to be a notch higher. Primary residence conventional loans right now are probably going to vary right around that 7% range, maybe 6.75 to 7.25. Once again, depending on your FICO score, they're going to be right around that 7 on average range though.
Now, when we say primary loans, we're obviously referring to a primary residence loan. That means you have to move into the house to live in it. Is there a range for how long somebody has to live in a house if they buy a primary residence?
Yeah, this is a actively discussed topic. And I'll say, as a licensed loan officer, I am obligated to say there is not a range. There is a set amount. It's 12 months. Right. You gotta stay in there for a year after you buy a primary residence. Now, keep in mind, guys, that's not just conventional. Any loan product where you are saying you're occupying the house, that's FHA, that's VA, that's primary conventional, that's even non-conventional primary residence mortgages. Remember that you can't, those are a thing. You can get a bank statement loan to qualify if you're a self-employed person. Any loan where you are certifying that is your primary, you start your 12-month time period where you are intending to occupy that property as your primary.
All right. And are we seeing a little bit of that in the industry? Have we seen people that have bought houses and then they didn't move into them and got themselves a little bit of hot water?
This is actually a great thing to include in here in this discussion. There's actually a big lawsuit that was just filed. It's a New Jersey-based lender, very, very well known. I'll leave the name off for the video. But if you guys do follow mortgage news, you may have heard about it. There's one of the top producing mortgage brokerages in the country is actually being actively pursued right now because of exactly this problem. They were underwriting every investment property purchase that they could make happen within reasonable boundaries. They were underwriting them as primaries, and they were just telling buyers not to move in. And they were beating the rates of everybody. They were beating the down payments of everybody. Well, they were beating everybody else because they weren't using investment loans. Of course, they're going to win. If I price a primary residence against your investment, I'm going to be the cheaper loan product for sure. That's why it's a primary. There is absolutely an uptick in this, David. So if any of our listeners are considering doing this, like, hey, let's buy that fourplex and not really move in and only put 5% down, please, I preach caution. We're not in a super healthy economy. We're not in a place where banks are just going to be willy-nilly and let everything fly. These things are getting investigated. These things are getting called due. There's a lot of things happening in the background of the industry right now where if you are thinking of riding that gray line a little bit of mortgage fraud, I would absolutely advise or stay on the green side, right? It's not worth jumping over ever, but specifically in this economy, in this financial environment.
There you go. So you don't have to be afraid if you've bought the house with the right motives and something changed, but you should be afraid if you are buying a house as a primary residence and never intending to occupy it in the first place, which moves us along to our second conventional product, the second home loan, which we actually do quite a few of these at the one brokerage. The benefit to this is you can get by with a 10% down payment instead of 20. And even though 10 and 20 don't sound like big numbers, it's actually 50% of the down payment, meaning you could buy twice as many homes if you could get by with a 10% down payment instead of a 20%, or almost 7 times as many homes if you can get in with a 3% down payment versus the 20% down payment of the investment property home. We just went over the primary residence loans and that we can do those for 3% down. Moving into the second home loan at 10%, where are rates for that?
Yeah, obviously bigger strength, 10%. Second home has to be a vacation home. You have to occupy it for usually 14 days out of the year. You can rent it out when you're not there. The rates right now, they're actually in line with where just a true 20% down investment property is. Usually these loan products, if you just guys want like creative tips to being able to project where rates are in the industry, if you start with government, which we had at 6.5 or so, just on average, usually primary conventional is about 0.5% higher than that. So that's where we were at the 7%. If you go to second home and investment, usually you're about 1% higher. So for those, I would say 8% on the low end, 7.5 to 8.5 in that range, depending on credit and down payment. But those are usually the tips, right? Government, add 0.5 to get to conventional, add 1 to get to investment. David, to answer your question, around an 8% on the low end, 7.5 on the high end, 8.5 once again, depending on where your FICO score and down payment is.
All right, there you go. Now, what is the person that should be using a second home loan and what is the person that should not be using a second home loan?
Problem with second home loans is that they're not investment properties. So the person who shouldn't use it should be the person who needs the income from the property to help you qualify, right? When you purchase an investment property, we can add income to your qualification in the file and we can qualify you for more because you're realizing new income in the property. A second home generates no rental income. Even if your plan is to go rent it out, I can't credit you with it on your loan application. So you have to be able to qualify for all your existing debts, your primary house, anything else you own, plus a brand new mortgage. If you're getting a second home, it's not supposed to be on professional property management and it's supposed to be available to you 6 months out of the year. Once again, this is only your first year. The second home rule is the same exact rule as a primary. You can get one a year. After that, it can convert into an investment property, no problem. But you can have one a year. So if you really think of how to maximize, David, imagine you're buying a 3% down property every year and a 10% down property every year that after those 12 months are converted to a rental. Now you're buying 2 homes a year with what? 13% down. That's pretty cool. Those are converted into investment properties and you're in for almost half the down payment than you would have had to do otherwise.
And the last of the conventional loans is the investment property loan. This is what most people know about. It's typically 20% down. Sometimes it can get up to 25 or even 30% down. Where are rates for these?
Very similar to second home loans. They're hovering around that 8%, sometimes a little bit higher. The big thing to note with investment property loans is every bracket of 5% you put down, over 20% drastically improves your rate. So 20 versus 25 versus 30% down in this example, that could be a difference of like 0.75% of an interest rate. So that could be a difference from 8 to 7.25 sometimes. But right around that 8% is usually where they're hovering as well. Once again, 7.5 to 8.5, depending on points and credit.
Now, again, investment properties loans are when you're buying a property which intended use is to be an investment property, which is what most people that are going to be listening to a podcast like this and wanting to build wealth through real estate are going to do. And that's one of the reasons that I'm such a big advocate for house hacking, because you're going to get a better loan product. As you saw, it has a better rate and a lower down payment. And then you can move out of it after you've been in it for a period of time, usually 12 months, and get another loan. That's the best you can get. All right, moving on. The non-conventional, also called non-QM. QM stands for qualified mortgage. Is that right, Christian?
That is correct.
All right. What are the non-QM products that you recommend and where are rates for those?
It just means they're not conforming to the guidelines established by the government entities, Fannie Mae, Freddie Mac, the VA, that establish all of these loan products. These are loans that fall outside of that realm. So it doesn't mean they're bad loans, still 30-year fixed, a lot of options for 30-year fixed, good rates, still competitive. It just means they're not one of those government-sponsored loan programs. Okay. The most popular one by far and away is the DSCR loan. If you guys are fans or listeners of Mortgage Mondays, we talk about this loan a lot. It's a great loan product for investors. It's most investors' only option to get long-term financing on a rental. This is the product that qualifies you with the cash flow of the property, similar to how commercial properties work. Instead of your personal debt to income. These still do require 20% down, but this is a pretty exciting part of the video. DSCR rates are a little bit of a parity right now. What do I mean by that? Just like I gave you the cheat sheets, conventional, add a half to get to primary, add a full percent to get to investment. Usually DSCR loans are even another full percentage point above conventional investment. So if conventional investment was at 8, DSCR loans should be around 9. Right now, they're in like the high 7s. So we're in this really weird point in the industry where DSCR rates have some parity with conventional rates, which means you can get a better deal sometimes on a DSCR loan. We're taking people who qualify conventionally, and a lot of them are choosing to get a DSCR loan. First time in the industry I've seen this happen. This has never been the case. It's happening because we've reached that breaking point where the Fed increased the rate high enough and kept it high for high enough, and institutional banks are okay accepting a 7.75% return. There's a parity now with what banks are okay receiving for return on their cash is not in line with what the Fed is saying rates should be at.
When you want to understand interest rates and why they are where they are, you need to look at who's going to be buying the loan. Conventional loans are going to be bought by Fannie Mae and Freddie Mac, and they're going to be packaged up and sold as mortgage-backed securities on the stock market. The people who buy those mortgage-backed securities buy other products, typically 10-year treasury notes, and that's why you see mortgage rates and 10-year treasury rates tend to be very close to each other because if one goes too high, everybody flocks to that one. And if one goes too low, well, it gets harder to sell the product. But what you're telling me is that people that are not selling their loans on the open market, but to Fannie Mae and Freddie Mac, are okay making a smaller spread on these loans because they just want to deploy capital. And so for the first time since you and I have been in the business, the people that are buying these notes and holding them in their own portfolios, or they're holding them themselves, are willing to give you a better interest rate than the conventional loans that are sponsored through the government.
That's right. It's was. First, like I said, when we were buying during COVID, David, I mean, rates were, 2.5%, 3%. I have DSCR loans at 4.5%, at 5%, at 6.5%, right? As the market went up, DSCR loans were always about a full percent higher. It started to shrink about 6 months ago, where they were like maybe a half a point higher. And we're now at this weird point where they're even right in line, or sometimes, like I said, depending on the loan file, the DSCR is cheaper. It's super strange. It's something that I haven't seen. But if you are a buyer considering a DSCR loan, it may not be a bad time to lock it in when DSCR rates are lower than conventional rate.
No, I wouldn't expect that to last. Like, I think if you've been on the fence about this, you need to rush in and get your DSCR loan now while you can. That's amazing.
Historically speaking, DSCR rates should be at 9% right now. They're not. They're in the 7s, which is wild.
That's incredible. Maybe we should look into refinancing some of mine. All right. We've got two more products, the bridge loan and the HELOC. Tell me where rates are for bridge loans right now.
Yeah, bridge loans, otherwise known as hard money, otherwise known as renovation loans, however you guys want to call it. These are loans, typically short-term loans, high interest rate loans. As you guys can see, we're starting from the lowest rate going to the highest, right? Bridge loan is hard money, right? It's money you get to renovate a property. They're usually 12-month terms, really quick payment periods, interest only during the holding. All of that goes to say, answer your question, David, rates are between usually 10.5% and 12% right now. If you have a private lending connection of a person who really likes you that you've done 6 or 7 deals with, could you get a 9.99%? Sure, but my job is to give you where institutional money is, which right now is 10.5% to 12%.
All right. Last is HELOCs. We offer HELOCs on primary residences, second homes, and investment properties. Where's the rates for each?
Rates will vary depending on each of those three things you just said. What is the property use? Primary, second home, investment. If it's a primary, you're probably going to be 8.5 to 9.5. That's roughly where they land right now. Second home investment are going to be pretty much similar. They're going to be 9.5 to 11.5. I mean, they have quite a wide range. Once again, HELOCs are very, very much determined pricing-wise based on how much you're leveraging. Are you going up to the absolute cap, your FICO score, and how much your loan is on the first part of the house, right? So HELOCs are a second position loan. All that means is that you can keep your first mortgage from COVID that's at 2.5% that nobody wants to touch, right? But you can still extract the equity on the remainder of your equity. You can still extract a percentage of it using a HELOC. The benefit of it is that even though they're high rates, you get to keep that first, really pretty interest rate on the first mortgage in place.
All right, there you have it. All of your main food groups when it comes to loan options and today's interest rates, brought to you by none other than BiggerPockets and Mortgage Monday. And before you click out of this video, give me a lowercase if this was something that you already know, and give me an uppercase if you learned something new today. Please take a quick minute to subscribe, like, and comment on today's show. That means a lot. And then reach out to us and let us know if you have any questions. If you've got a second, check out another BiggerPockets YouTube video. And if not, we will catch you next week on Mortgage Monday.